Yeah, he works at KPMG. Yeah, well, we do we're technically on the same team. We're kind of be all around, jumping on projects. Yeah, we have. Research on like Japan, and I like research the same thing with that. So like to be able to give us their harvest.
I'm glad we were like sending to like
Why not? Oh, okay. Oh, yes. Yeah. Okay. I mean, I read little reviews of it. The point of a book probably is getting podcasts. I've discovered when I read my one book, I don't read the type book anymore. Yeah, but then you get on the podcast, and it's like, no, I was on the meetings back in 2016, and I think 68,000 people in the first weekend, and it was more people than I've read in his entire life. You know? So it's like, for me, it's a good podcast. Although I think the people who do research on what they have.
All righty. I feel like saying go Knicks, but I guess that's not quite the point of this meeting. Okay. I'm Bob Rubin, and I have a very simple function on behalf of my colleagues at the Hamilton Project and our partners at the Tax Center at NYU Law School, which is to bring together all of us for discussion of tax policy. I'm going to make one set of opening comments, so sort of a setting the stage kind of comments. As you all know, the debt to GDP ratio is about 100%. According to the Yale Budget Lab, which Natasha Sarin runs, she's projecting a debt to GDP ratio of something like 140% 10 years from now, assuming with the sheet uses realistic assumptions about defense and interest, and not counting the benefit of tariffs, but with the change in the tariffs, there's very little to that. It was about 136% without, even if you count tariffs. Furthermore, if you look at the expenditure side of the federal debt, of the federal budget, about 75% of that is entitlements and interest. So you only have 25% left for everything that is defense and non-defense discretionary. And that splits, according to Natasha, about 50-50 defense and non-defense. So while presumably there are savings that could be made on the expenditure side, I think it's pretty clear that if we're going to have a sounder fiscal trajectory, and I think if we don't, at some place, at some point, I think we'll pay a very, very large price for it, probably over time rather than all at once, but nevertheless, in various respects. If we're going to have to fix our fiscal trajectory, it's going to have to be largely on the tax side. And in that context, a lot of it's going to have to be on the business tax side. And that gets you into issues around growth. It gets you into issues around revenue effects and distribution effects. And that is the point of today's discussion. A couple more comments, and then I am finished. We're going to release 3 policy proposals later today that relate to, or maybe I think they're in your materials now, that relate to business tax reform. And then there's going to be a framing paper that sort of goes back, not sort of does, go back to what I said a moment ago, which is what is our framework, what is our outlook? And it is, to say the least, deeply troubling in terms of the risks that it poses. We'll have 2 panels. The first will discuss the way forward on business taxation, and the second will discuss the rather complex question of pass-throughs for business. And with that, Richard Rubin of the Wall Street Journal, the distinguished journalist, will moderate. Richard, it's all yours.
All right. Good afternoon. We'll bring up our, am I on here? Yeah. We'll bring up our first panel, and I get this question a lot. We're not related, just for clarity. I might not admit anyway. So with us, we've got a great panel here today. Starting right next to me, we have Lily Batchelder from NYU Law School and formerly of the Treasury Department. Kim Clausing from UCLA Law School, also formerly of the Treasury Department. Elena Patel from the Urban-Brookings Tax Policy Center. And then joining us remotely, and we'll see him on the screen at some point when he's talking, is Arvind Ravichandran from Cravath, Swaine & Moore. And as you'll see, he is injured, but braving it to be with us today. Elena and Kim each have wrote or co-wrote one of the papers that was released today. And so they're each going to outline what those papers lay out. Lily and Arvind will respond to those, we'll ask some questions, and we'll have some time at the end for audience questions. So please think of those if you're in the room. Elena,
I will take it away. Yes. Hello, everyone. It's nice to see you. I'm going to talk a little bit about the paper that I wrote with Bill Gale and Adam Looney. Hopefully it provides nice framing for the whole conversation. I think you'll see that Kim's paper and our paper are very related to each other. And so keep that in mind as you think about this. The starting point for the paper is really just admitting that the U.S. corporate tax reform project is unfinished. So over the last 2 decades, Congress has been moving it incrementally toward a different kind of tax. I think with the notion of one that does not distort investment decisions the way the current income tax system does. But that shift was really never completed. And so as a result, we have a hybrid system that kind of has the problems of both systems without the virtues of either. In its current form, it distorts business investment and how businesses structure themselves in a way that really has nothing to do with underlying economics. It also raises too little revenue at a time when the fiscal outlook couldn't be more sobering. Corporate receipts have been flat or declining for decades, alongside rising corporate profits. As you already heard, our fiscal outlook is bleak. CBO projects that our debt is going to reach 175% of GDP over the next 30 years. And I would say that's under what some would call wildly optimistic assumptions. And so it only gets worse from there. The One Big Beautiful Bill Act, as I will now say OB3, others may say some different shorthand for that. That was an opportunity to finish the job. And I do think it made one right move by permanently allowing full expensing for machinery and equipment. But it also rolled back limitations on interest deductibility. And I'll explain in a moment why those two things don't belong together. It also left untouched the fundamental reason profit shifting seems to persist, which is that we tax businesses based on where they produce rather than where they sell. And I think that's a problem that really no amount of patching will be able to fix in the current system. So what Adam, Bill, and I argue is something that might sound familiar to you, but has a different name. So I think the rebranding is going to help. We're going to call it a border-adjusted cash flow tax instead of a destination-based cash flow tax. You should hear those are the same. That's the idea. But I'll explain to you where our proposal differs from the 2016 DBCFT. The point we're trying to make in this proposal is that we're closer to that reform than I think most people realize. We just need to complete the transition. So to explain this, I'll make 3 points. I'll try to explain to you why there's a distortion in the hybrid system even after OB3. Then I'll explain why we have a structural problem that we really can't patch our way out of. And then lastly, I'll walk through the elements of the proposal quickly to make clear what it is we're proposing and why we're proposing it. So the first point to say in more detail, OB3 moved the corporate tax in 2 different directions at once, and the net result is worse. So there's 2 basic ways to design a corporate tax. You could have an income tax or a cash flow tax. One key difference between them is when businesses can deduct the cost of their investments. So if you take a company that spends $100 million on new machinery, under an income tax, they get to deduct that cost gradually over time, ideally in a way that tracks the machine's useful life. Under a cash flow tax, they deduct the full $100 million immediately. And it's that timing difference that matters. $1 of deduction today is worth more than $1 of deduction 10 years from now. When you can only recover costs slowly, the tax discourages some new investment, and when you recover them immediately, it doesn't. And so that's this notion that the cash flow tax does not discourage investment, but the income tax does. And then the second key difference is how the 2 systems treat debt. Under an income tax, businesses can deduct the interest they pay on borrowed money. Under a cash flow tax, they cannot. And as a result, the cash flow tax then doesn't give businesses a tax reason to borrow, but the income tax still does. So what's the problem that we're in? OB3 brought full expensing in a permanent way. That's great. That's a cash flow move. But it also relaxed limits on interest deductibility. That's an income tax move. So we've done 2 things at the same time that don't quite belong. So when you expense an investment and also deduct the interest you use to finance it, you've exempted it from tax twice under our current system. CRS, Congressional Research Services, estimates that the effective tax rate on debt-financed equipment investment under current law is roughly negative 55%. So that's not a tax, that's a subsidy for debt-financed investment. By comparison, equity-financed investment faces an effective tax rate around 10%. So that's a 65 percentage point gap depending on how you finance the investment. And I think that's just what you get when you combine 2 incompatible systems instead of choosing one. So the second point is that profit shifting is itself a structural problem, and we really can't fix it while we remain in an origin-based system. The current corporate tax is based on where firms produce. That means firms have an incentive to locate their income in low-tax jurisdictions, to book profits in low-tax places, even when underlying economic activity doesn't happen there. The TCJA did try to address this directly. It introduced provisions like GILTI, BEAT, and FDII. We renamed these. We revamped them under OB3. The problem is that it's not quite clear that this patching is working. I think profit shifting continues, and I don't think that's a failure of execution. It's just a structural feature of taxing based on where production happens. As long as we do that, firms will have an incentive to make their production look like it happens elsewhere. The only real fix is to tax based on where sales happen instead. Firms can move production. It's much harder to move where their customers are. And so now to get to the proposal itself and what it means for revenue, our proposal has 4 components that work together to hopefully fix the problem. So I'll walk through each of them. First, we propose to complete the cash flow base for non-financial corporations. That last part is an important caveat to almost all of these proposals. That means extending full expensing. We already have it for equipment and machinery. It needs to be extended to all investment. That would include structures, that includes intangibles. And then we need to eliminate the interest deduction. So that would eliminate the debt equity distortion entirely. Second, we should always be thinking about how we can clean up special provisions in the tax code. And so this is a moment to do that, just like conversations evolved in TCJA and OB3. The tax code itself is riddled with credits, deductions, and carve-outs that some estimate collectively wipe out 60% of what corporate tax would otherwise be collected. A well-designed cash flow system doesn't need most of that spending because we're already compensating for problems by going to a more efficient system. We would propose to keep certain credits, so we think of research and experimentation, for example, and clean energy as two spending programs that have really clear economic rationale and probably would stay in a system, but most of the rest we would propose go. The third is the border adjustment, so that means we tax goods based on where they're sold, not where they're produced. This is the key structural fix to the profit shifting problem. It's also, honestly, because we are a net importer where all of the big revenue can come from. The US persistently imports more than it exports with regards to goods. That means that if we are shifting to a consumption-based tax, it's substantially going to broaden our base. And our estimates suggest that this component alone roughly doubles what the corporate tax raises. And then the last is to choose a rate. So we propose raising the rate to 25%. We think that once you have a base that doesn't distort investment, and once you have a base that is falling the hardest on the most profitable firms, which is what a cash flow tax does, then there's really every reason to raise the rate because of the progressive nature of the tax. So if we go back to revenue, corporate tax receipts have fallen from about 3 to 4% of GDP in the post-war era. Now they're around 1.2% of GDP. Again, at the same time that corporate profits have as a share of GDP have really grown. The administration right now has been counting on tariffs to fill part of that fiscal gap. But there have been a series of legal losses that I think have made that argument more complicated. The IEEPA ruling, the 122, current International Trade Court dispute. Under all of those situations, that means even the optimistic revenue in the CBO budget forecast is probably 50% too large. Our estimates suggest that our full proposal will raise somewhere in the range of $8.5 to $9 trillion over 10 years from non-financial corporations. So that's compared to roughly $4 trillion under current law. And it's substantially more than current tariffs are projected to raise. So that's the pitch for the proposal. It's more revenue from a more progressive base with less distortion to the economy. And that's why we think it's important to finish the reform that we started in TCJA and with OB3. And given the fiscal moment, I think the case for doing that is right now.
Great. Kim?
Thanks. And thanks to Hamilton for organizing this. Thanks to Aviva and Rob and everyone. It's been terrific to read the other papers, and I think this conversation is really important for the reasons that have already been alluded to. So I suggest a reform that is different but complementary, I think motivated by many of the same issues that Elena raised. In particular, I suggest a higher corporate rate, a cleaner corporate base, with a somewhat different approach to international tax, which I'll get to in a minute. But the foundational axioms that are kind of behind this proposal are three. One is that we need revenue, right? And as Robert mentioned earlier, there's only so much you can do on the spending side. So we're going to need revenue. The natural place to look for revenue is on the capital income side, right? Capital income is undertaxed relative to labor income. And once you've admitted that you want to go to capital income, the natural place to do that is with entities. Why? Because more than 70% of US equity income, we don't even try to tax at the individual level, right? It's either in foreigners' hands where we don't tax it, or it's in tax-preferred accounts, or it's in tax-exempt entity hands like endowments, right? Whereas when you get to the entity level, you get to an entire bite of the capital apple. And so that's really the place to start with revenue. And so I think both of our proposals raise a lot of revenue there. The second big motivation for my proposal is that, in my view, the international tax problem is an international global collective action problem. It's very difficult for one country to solve alone, and that's because the pressures of tax competition and profit shifting are very real, and the dangers of having systems that aren't well aligned, I think, are also very real. The United States can certainly do things unilaterally. We've had quite an experiment with that lately. But there are huge costs and there are huge risks to doing that. You can end up with double taxation or double non-taxation. You can bet entire industries on whether an exchange rate will adjust. And then there's geopolitical costs too. So luckily, I think in this space, US interests and the interests of other countries are actually really well aligned. So we should be able to build on that. And I think the 2029 moment would be a natural time to do that. The Pillar 2 reforms, which I'll get to in a second, are due for a stock take at that moment. And the United States, if it acted first, I think could have credibility in shaping what future Pillar 2 reforms look like. So the third point that I'll make that's, I think, foundational to the proposal is that there's two really strong policy goals out there that the corporate tax can address. One is we're going to need some response to this AI thing, right? Everybody wants to talk about AI. AI is really important, but we don't know exactly what it's going to do yet. But if it does generate a lot of corporate profits, whether it's in the AI firms or the firms that are using AI, right, it's important for us to be able to tax those, to have an adequate tax base. If it makes the labor share of income smaller, it's important for us to have other tax bases for that reason too. So for both distribution and technological change reasons, I think this is important. And the second big motive that people have is they want to respond to offshoring, right? And we see this with the Trump tariffs. But the Trump tariffs are incredibly regressive. They're incredibly inefficient. They're a huge thumb on the scale for what we do badly and a huge thumb against what we do well, right? Whereas the corporate tax changes that I propose are moving more to eliminate a thumb on the scale for foreign income at the same time that they are a progressive source of revenue. So what do I suggest? A higher corporate rate of 27% for less than 2% of corporate taxpayers and of 29.7% for less than 0.5% of taxpayers, which means 98% of taxpayers wouldn't face a corporate tax increase, but you still get the vast majority of the tax base included in the corporate tax increase. In fact, this proposal would raise more revenue than if you just did 27 for everybody. I think there are advantages to the tiered structure. One advantage is a political one. You can tell 98% of taxpayers that they don't have a tax increase. Another advantage is you're putting a thumb on the scale in favor of smallness. And we have a lot of things in our economy that are leading to concentration and excess profits potentially for some firms, right? So I like that proposal. Like Elena, I suggest cleaning up the base. I think that's a very important feature. And the more we can get it towards a tax on rents, the more it's both progressive and efficient. So that is something that I endorse. I do think there's a difficulty associated with completely eliminating interest deductibility. I think businesses will hate that. So realistically, both for pragmatic reasons, because Penn Wharton didn't have enough time to score the full thing, and for other reasons, I thought it was useful to look at what would happen if you just limit interest deductibility, and that's what's scored in the paper. And I suggest a reformed minimum tax, and the reform would take a country-by-country feature, which is really important because the U.S. minimum tax right now is effectively a maximum tax. You can blend low and high income streams of income from throughout the world. And that gives the US a big advantage relative to firms based in other countries. But that's not a sustainable tax competition equilibrium where we get better treatment than everybody else. And I also suggest lowering the deduction for foreign income relative to domestic income to a mere 15%, which keeps us within historical norms of the gap between how we're treating foreign income and how the most favored nation, not in the trade sense, but in the other sense, might treat their foreign income. So by overshooting kind of what the Pillar 2 reforms have done, which many countries are now committed to 15% tax on their foreign income, we would have the credibility then when the stock take comes to build on it and say to our trading partners, look, we're credible, we believe in taxing corporate income, we think we can go higher internationally, perhaps even to 18 or 20, which would make our tax rate on foreign income look more reasonable. Now, the business community isn't going to be thrilled with either of these, frankly. But I think there are some things that you can tell them. One, there's less complexity, right? I would suggest turning off the CAMT and the BEAT, for those of you who know those acronyms, for the reformed minimum taxpayers, which means that they would be more aligned with what the rest of the world is doing, and they just face one minimum tax regime instead of 3 or 4. Also, I would suggest getting entirely rid of the tariff regimes of both the first and second Trump administration. And that would also improve the international global business community's situation, in addition to being better aligned with our allies and partners that are facing challenges. So I think there are some positive things you can tell the business community. And finally, I would note that these tax increases are big, but they're not that big. So mine, for instance, would raise 0.86% of GDP on corporations. What does that number mean? Well, it means we would move from being between 1.5% and 2% of GDP, in typical recent years of the corporate tax, to being, closer to 2 to 2.5% of GDP, higher than we were, but still well below the international average, which tends to be more like 3.5% to 4% of GDP. All right, so we're about 1.5% of GDP lower than the typical OECD country. This closes half that gap. So it's not that much. It's a very progressive reform. And one other thing that I'll just point out in my last 17 seconds is that when you reform the corporate tax in the way that I suggest, some of the burden actually falls on foreign shareholders, because foreign shareholders have shares in U.S. companies. And that's a feature, not a bug, right? They are participating in the success of the U.S. economy. They can help fund the state. Tariffs, we've been told that foreigners pay those, but they don't, right? Those are falling on U.S. consumers and U.S. businesses. So this is a way to get a lot of revenue that doesn't entirely fall on the shoulders of the American taxpayer.
Great, thanks. Lily?
Well, thank you also to the Hamilton Project for this great event, and thanks to Elena and Kim and co-authors for some really terrific papers. I enjoyed reading them so much and encourage everybody to do so. And I think the papers make a bunch of really important points. One is that we can and should tax business income and corporate income more. Business income is capital income. A lot of it escapes tax at the individual level, as Kim said. And it contributes greatly to progressivity, to tax business income, and in particular corporate income. It is insane that we are subsidizing debt-financed investment as much as Elena described, a negative 55% rate, and the spread between debt-financed and equity-financed investment just boggles the mind. People on the left and right agree that is crazy. There is a long-standing problem with profit shifting and with the corporate base being too narrow. And the TCJA and OB3 and the international tax approach of this administration have made that situation worse. And that the U.S. needs to lead or at least participate in multilateral efforts to stop profit shifting, rather than asking for special treatment where we facilitate it more than our competitors. And so I agree very much with Kim that the Pillar 2 agreement is critical to build on rather than to step back from. So the area that I wanted to press both of them, and perhaps a bit more on Elena's paper, is on the merits of moving to a DBCFT or a BACFT relative to moving back to sort of the other pole. And I think we all agree that the middle ground we're in is terrible. And the other pole being a corporate income tax and higher rates. And I have three concerns with a DBCFT. The first is political prognostication. So I have no crystal ball, but my personal political prognostication is that a DBCFT wouldn't happen the way we hope. And in particular, that we'd probably end up with more expensing and not with repealing interest deductibility, which would make our horrible situation of these very negative effective tax rates on debt-financed investment worse. The second is that I think the efficiency and distributional arguments are relatively mixed, and so I'll say a little bit more about that. And that the last is that a DBCFT, and maybe more the destination part, but also the cash flow part, would be a huge setback to multilateral tax cooperation. And that would in turn lead to more profit shifting and thereby reduce rates on the largest multinationals when we should really be increasing them. So the net result, I fear, and all of this is sort of how things would play out to some extent politically, is that we'd end up more heavily taxing labor rather than capital, and we already do that, and we just sort of worsen the existing situation. So first on the political concerns, I just don't see how Congress repeals all interest deductions. We've never done that in the 100-plus history of the income tax. I tend to lean more towards the other pole of going back to depreciation deductions that roughly mirror economic depreciation. And I admit that that would be a very tough sell with Congress too. I just intuit that it would be even harder to get rid of interest deductions. And you could still retain expensing for small businesses, which has long been the case. I think some people think you could get a higher rate if you had even more complete expensing, which is perhaps true, but I think once the choice is between more economic depreciation or eliminating all interest deductions, I wonder if you could actually raise the rate, or you're more likely to be able to raise the rate in the context of economic depreciation. But again, I don't have a crystal ball, so if the politics played out differently, that would be a big consideration. The second point I wanted to make is I think the evidence for efficiency and distributional benefits of a cash flow tax specifically are more mixed than the economic models usually suggest. So these models are that a cash flow tax would reduce the marginal tax rate on new investment to zero while raising it on rents if you held revenue constant, because you would then raise the corporate income tax rate. But these models are based on a series of assumptions that I don't find terribly realistic. In particular, they assume that CEOs and investors and creditors and analysts of large businesses all have perfect information about taxes, and their incentives are all aligned on maximizing the present value of the firm's long-term after-tax profits. There's a bunch of evidence more in the accounting field that many firms, and definitely investors and analysts, focus more on different tax metrics, like the book tax rate, which is the tax rate for public financial accounting purposes, or the statutory tax rate. So many don't have access to these tax metrics, and then there are some agency costs as well. And if they do focus on these different tax metrics, that can mean that a cash flow tax would actually reduce investment rather than increase it, because they don't take into account the value of expensing. These models also assume that the goal is to increase global investment and not U.S. investment. And so they're looking at sort of the marginal amount of investment globally by a firm. But if the goal is to increase U.S. investment, there may be a lot of rents in the locational choices of where to locate investment, in which case, all else equal, if a cash flow tax necessitated a higher statutory rate and higher taxes on rents, that could reduce U.S. investment. And then I see I'm running out of time, so maybe I'll save for later a lot of my profit shifting concerns. But I guess my main point is both that I think there's a little too much optimism about how shifting to a destination basis would eliminate the ability to profit shift. So you can really game the location of sales as well. And if you just think of, let's say there's a business headquartered in the US, it buys cloud services or AI from a project that's executed by employees in Singapore. Where do you say that sale is? What if you have an AI or streaming service that's sold? Is that the sale located where the server is? Is it where the customer's billing address is? Is it where they were located when they accessed that AI? So there are a lot of different ways to game sales as well. And I fear that especially as our economy is moving less from tangible assets to digital and IP assets, that that would not have the benefits that it has. And then finally, I fear a DBCFT would really leave multilateral tax cooperation in tatters. It would be a unilateral move by the US that would completely undercut the whole predicate of Pillar 2, and all the countries would have to go back to the negotiating board. And even if we somehow got every other country to agree to totally shift their income tax to a DBCFT, you would potentially have years of profit shifting that was left unchecked by any multilateral agreement. So my preferred solution, given these, would be to shift more back towards a corporate income tax and raise the rate as well. And there are not any real recent estimates of this, but some older estimates suggest you could raise on the order of $2 trillion by moving more towards economic depreciation, maybe more like $1.8 trillion if you also got rid of the limits on interest deductibility. And so if you contrast this with the estimates in Elena et al.'s paper, where a cash flow tax setting aside rate changes or the destination basis would raise $400 million, I see a bit more revenue potential that way.
Great, thank you. Arvind?
Hi, can everyone hear me?
Yep.
Yes.
Terrific, and thank you so much for inviting me, and thank you so much for accommodating me after I had a little bit of a rough morning, spent it in the emergency room, and I appreciate everybody letting me join virtually because this is a lot of fun, and I'm really glad to be able to be here. So I'm going to offer, I think Lily's critiques were very fair. I'm going to offer some unfair critiques, but let me explain what I mean by that. So I think my first critique really is details matter, and I think that's an unfair critique because these papers are deliberately intended to be high level, and there's certain aspects where they deliberately say, like, this is a detail that will have to be worked out later. But I think they can matter, and I want to give you an example of exactly what I mean by that. And it's a very recent one. It's CAMT, right? The Corporate Alternative Minimum Tax. The CAMT, when you think about it conceptually, is actually a really good tax in the sense that it ought to raise revenue and it ought to have really low administrability and the administrability costs. And the reason for that is that the way large companies, and those are the ones that are supposed to be subject to CAMT work, is that they handle all of their internal processes on an accounting basis. So they have accountants. Well, they start with the accounting statement, and then they, often what's called return to provision, they make the changes that they need to make where tax differs from accounting in order to fill out their tax return. So they're already starting with an accounting statement. This is why CAMT in principle could be very, very helpful, because what you would do is you would just come in, you slap a tax rate on the income statement that's already been prepared and collect the tax. Boom, done, right? That's not challenging really to administer. There's really no administrability costs in concept because you're already doing all the work. There's no distortion because people aren't going to be changing their financial accounting for tax results. And of course, it by hypothesis raises revenue. But of course, we all know in this room that's not at all what happened, because there were exceptions that you had to make, and there were political pressures on what was included and excluded from CAMT. And what ended up happening was, rather than having a low administrability cost system that raises meaningful revenue, you ended up with a very high administrability cost system that raises almost no revenue. And that all arose because of details, right? The CAMT statute itself is relatively short, although I think it includes 14 or 15 statutory exceptions on its own. But you had lots and lots and lots and lots of details that had to be worked out that actually fundamentally changed the tax. And unfortunately, many of the same people that pushed CAMT would also say they were very interested in examinations and audits of wealthy taxpayers and successful corporations. And that's, I understand the rationale for both, but it turns out that if you have the IRS and Treasury spend all their time implementing CAMT, they have much less time to actually go after those very same people. So not only was it a cost to the actual substantive tax, but it also interfered with other goals. Now again, that doesn't necessarily, I don't mean to damn CAMT, but rather to just illustrate that details can kind of overwhelm a otherwise meritorious proposal. So I think that's unfair critique number one. Unfair critique number two is there is, I think, an implication, right, in the papers that taxing rents is generally okay. And I think that's based on economic theory, which I'm familiar with, though certainly not as well versed in as our panelists, that effectively rents are rents, and so they don't really change behavior at the margin. That makes sense. But I think one question I would have is, let's take a simple venture capital style investor, right? So a venture capital investor, I'm going to exaggerate a little bit here, but makes 100 investments. 98 of them are terrible. They make no money. In fact, they get wiped out. They lose everything. But 2 of them are really, 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 really successful. And for a venture capital fund to hit the rate of return that it needs to demonstrate success to its investors, it has to have those 2 investments be way, 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 way profitable over the other 98 to make up for the losses on those 98. So in some sense, maybe there are rents at the margins, but I wonder if there's a question about whether the necessity to make such a high level of profit might interfere with the treatment of those investments as a rent. And then relatedly, certainly an issue that has been in the political sphere is distribution of wealth. And anybody who's following the SpaceX IPO is probably getting in notifications every 30 seconds on their phone about how much wealthier Elon Musk is. But the raising of the corporate tax rate, together with my point earlier, if it's successful, it almost requires that those hit companies be even more valuable in order to sustain the additional corporate tax rate. And I wonder if that again interferes with a different goal of reducing distributional wealth. So I think I'm at my time, but those are kind of the two, and I admittedly unfair critiques that I had.
Great. Well, thank you. I guess I'm gonna ask a couple questions. I want to start. I think both of you mentioned sort of the historical comparisons of U.S. corporate tax revenue as a share of GDP to what it used to be, and the papers make this point, but I'll just put the big asterisk for the audience, which is, as opposed to the past and compared to other countries, the U.S. a lot of U.S. business income is in past reform, and so is outside the corporate tax to start with. So those comparisons, I just put a star next to them. In the next panel, I'll talk about some of that. I guess for Elena, I wanted to congratulate you on becoming Paul Ryan. Like
it's
everything.
what I aspired to be.
Right, but everything like comes right. Here we are, like 10 years later, and like, the Tax Policy Center is right there where House Republicans were, and the problems they ran into were in some ways political, but they were also about the size of the economic disruption.
Yeah,
and the paper lays this out on prices, on wages, on exchange rates, on potential windfall benefits of foreign holders of U.S. securities. Can you just sort of address some of the transition rules and size of adjustment that would need to happen and how policymakers should think about that?
Yeah, I think I can address it at a high level and just admit, frankly, that I think some of why apparently I'm succeeding Paul Ryan, but I will say that transition, was a big noose around the neck of the policy that was proposed in 2016. It's not very different than what we're proposing today. I think it's important to take transition very seriously. I spent a lot of time at Treasury, and putting rules on a piece of paper that match an idea is actually a very complex process. That's what Lily talked about. And I think you have to start with a good white paper, but you have to get to a set of administrable rules. And that's already assuming you've gotten to equilibrium and the system is set up and everything is humming. And how you get from current income tax to maybe the holy grail that is the destination-based cash flow tax, I think remains a thorny question for all the reasons that you propose. What do we do about pass-throughs? I often say get rid of them. We don't need pass-throughs. But there will always be sole proprietors, and so you will always have to deal with pass-through treatment, whether you want to deal with it or not. So I've sort of softened my hard stance I used to take. And I think it's a serious part of any consideration of any business tax reform is how you think about pass-through. We have a lot of outstanding debt in the economy. It's not even talking about the federal government. People have outstanding liabilities right now. And even when we went from the pre-TCJA to the TCJA with the interest limitation itself, some of the transition was thinking about how do you deal with old net debt versus new debt, and the notion that debt can be recapitalized, and how much of the current debt has capitalized in the limitation. And so then what happens if you restrict it further or go the other direction? Those are all really important disruptions. And I have not yet written down the transition plan. I think the thing I worry about in transition is that the equilibrium revenue might be really awesome, but I worry that we have to give away a lot of it to make people feel comfortable. And also, we would have to do it in a way that was politically durable so that you don't give up halfway through. I think all of the things that Lily raised that one might be concerned about, that you sort of start down the road and then it feels a little painful. And then you're in the position of somebody saying, I know it sucks now, you just got to hang on. I feel like we hear that a lot right now in trade policy land, for example. This is uncomfortable, but it might be a means to an end that's worth it. You can decide whether or not you agree with that, but you can already feel the pushback even in this really particular corner. And so I will just admit that there's an appendix to the paper that tries to tackle these on a one-off basis, and you might feel overwhelmed going through the appendix. I will tell you we were a little overwhelmed writing it because you have to be frank and admit that, yes, I think the equilibrium outcome is great. I do worry about the 10 kind of roadblocks that stand between here and there, which is, I think, why in 2016 we had so much trouble getting the DBCFT off the ground.
Yeah, I feel like I read the paper and I was wrote down 6 or 8 things, and then they were all there were the 6 or 8 things in the appendix that you try to deal with, but they're all there. Yes. For Kim, you talk about having the tax on U.S. companies' foreign income be significantly higher than it is now, and it'd be at a point where it'd be above what other countries would charge for their home companies. And I think your point is just then have the U.S. be the anchor and pull other rates higher. But the other way that might happen is sort of the competitiveness argument that other that companies would find ways to be more foreign, that it might be more attractive for new growth startups to locate elsewhere as opposed to here. Inversions aside, that's its own thing. But like just that it'd be an incentive for companies to be non-U.S. companies. How would you deal with that?
Yeah, those are great questions. So first of all, I would point out that there are a lot of non-tax things that really determine how successful a company is. And I think it's important for all of us in the room who care about tax to recognize that that special sauce is really important. And in the United States, there are things like our technology policy and our science and our strong higher education and our welcoming the talents of the world that have made our business successful, our businesses incredibly successful, right, and very profitable. And they have been for decades at corporate tax rates that were 35% to 46%, much higher rates. But you raise a good point, which is whenever you want to raise the tax, particularly on the foreign income of firms, they say, hey, this is a competitiveness problem. We're never going to be able to compete with our lowest tax competitor abroad. For a long time, that competitiveness differential was 35%, because we had a 35% rate on our income. We purportedly taxed the foreign income, although we didn't until it was repatriated, and the lowest possible rate abroad was 0. After Tax Cuts and Jobs Act, it was somewhere between 10.5% and 13.125%, because our minimum tax was at that level, and the lowest possible was 0. Now, the lowest possible is 15, and I'm saying we should go to 23 to 25, which is still higher. And you're right that maybe we could get the 15 to go a little bit higher, but 23 to 25 is still higher than 15. Mm-hmm. So there's a trade-off here, right? We can either say, well, we don't have to be the lowest common denominator country of the world. We can lead and we can help to pull others along. But there's also a second distortion to be aware of, which is the domestic income versus foreign income, right? If I'm talking to a voter in Ohio, and I'm saying, we should really worry about how U.S. multinationals do in global merger and acquisition bids, and that's the chief competitiveness. They'll say, no, the chief competitiveness problem I'm worried about is whether there are jobs in Ohio versus abroad, right? That margin is really important too. So when you change the 15 to 23 to 25, that 23 to 25 is closer to the U.S. rate, which would have been 27 to 29 in mine, right? And so you're reducing that distortion. And I would argue from a national interest perspective, that distortion is probably more important than this other distortion, particularly because the firms that are facing that higher rate are some of the most unbelievably successful and not that perfectly competitive. So I'm pretty sure SpaceX will make it either way.
Lily, I want to see if you could respond to Arvind's point about rents, and then just first explain what rents are, for a non-tax audience or non-economic audience, when we say rents, we're not talking about like rent checks for your apartment, but what does it mean, and how high can the rate on those rents go?
So, Kim and Eleanor are the economists, so they could probably explain this even better. But rents are supranormal returns, so sort of what you would expect, I guess, and risk is complicated, but maybe in a riskless investment would be a normal return. And when you get a much higher rate of return, that would be a rent. And so the theory is that a company will keep investing in as long as they're earning the normal rate of return. So if they're borrowing and they can borrow at 6%, they will keep investing until they earn 6% if there's no tax. But if they could earn 10% on a project, they'll definitely invest in that. And so if you tax just those rents, which in theory, and I have some concerns about this, a cash flow tax does, you aren't affecting their marginal investment decisions because they're always going to invest in a 10% project, let alone one that's returning 1,000%. My concern with that is that that's focused on a global basis. And so if a company is a large multinational, they have tons of rents often, lots and lots of rents. And so if they're thinking of locating a semiconductor fabrication plant, or they're thinking of locating their IP, or some discrete investment that's earning tons of rents, then they actually care what the tax rate is on rents in the US versus the other countries that they're thinking of. And so if that's the metric we care about, then the sort of theory of a cash flow tax being non-distortive is sort of false apart.
And then for Arvind, I'm just curious how, from the practitioner perspective, like how you think companies might respond to either of the proposals that are laid out in these papers. Like what would, if these were enacted, what would companies do?
So I think for Kim's proposal, there's not a ton you do in the short run, right? I mean, it's just kind of higher rates. For Elena's proposal, I think there would be a lot of chaos in the first instance as people are trying to figure out what it means in practice. And I do think, you mentioned transition. I mean, I think a key piece of the transition would be working candidly with the tax community to be able to position companies to understand what their obligations were in the short run and long run. I think I will say it kind of goes to both of these points. I think in the short run, taxes are kind of taxes. I mean, to Kim's point, I mean, SpaceX is going to succeed or not on the basis of tax policy. Where tax policy really becomes relevant to companies is kind of and to businesses generally is really much more so at the margins. And what I mean by that is just take a look at if you look at our two biggest AI companies, OpenAI and Anthropic, who are their biggest investors? Well, it's Microsoft, it's Google. Right, it's companies that were clearly very, very profitable, probably earning rent, as we just talked about, reinvesting their profits in this type of technology. Are they able to make those same reinvestments if they have less, if their profits are greater taxed? I think that's where you really see it more than in the short run.
Well, I have one more, and then we'll open up to the audience. The papers talk about getting rid of tax expenditures or special tax breaks, but keeping some, like for an analysis paper for research and clean energy. But you don't name a lot of them, so I want let's name and shame. Like, what are the tax expenditures that we have now that are most ripe for elimination? Because we've in particular TCJA got rid of some or limited some. Like, what's still out there that I guess for anybody on the panel, like what's still out there that is sort of most ripe for removal or curbing?
I mean, in the context of my proposal, I think the export subsidy would be one that is way more expensive than anyone thought it would be, and is very poorly justified, especially in the context of the reforms that I imagine. I think if in the current world, you can make an argument about parallels with the NCTI GILTI regime, but in the Clausing world, those fall apart.
Yeah, I think it's important to make some distinctions. Like when you think about 60% of the corporate tax being wiped out, there's a lot of things that go into that. And some of them are big buckets that I don't think anybody on the stage would say these should go away. They're actually all the exemptions that also get layered into CAMT that made the implementation of CAMT so complicated, that we have expenditures for foreign tax credits. We don't want to double tax income. It'd be hard to imagine, even under the current regime, getting rid of those. There's good economic reasons that those lay around. Companies reduce their taxable income with losses offsets. We don't want to get rid of that. We don't refund losses. We force firms to carry them forward. We have to keep it around. Then you go to the general business credit, which is actually like 35 different credits, which I would describe 33 of them as cats and dogs. And so when I talk about repealing expenditures, it's not because any one of those is like a cat and dog that I don't personally support. For example, there's a credit for employers to provide paid leave. If you follow any of the work I do, I care a lot about paid leave in the care economy, and I think we should be trying to figure out how to support it. I just think the general business credit is not the way to do that. And so with the exception of R&E and clean energy, which I think have sort of spillovers into the macroeconomy that justify why those things should stick around, I think we can do other spending directly through the sort of legislative process as opposed to kind of shoving it through the tax code. So when I say repeal, I think of a lot of the cats and dogs, which again, I think everybody in this room probably has a cat and dog that is their favorite. It's not because I don't support those causes. I just don't think it's the most efficient way to be supporting that kind of program.
Lily, Arvind, you want to jump in on that?
Well, a big one I would get rid of is expensing.
Right.
But I mean, I also think, and you mentioned the general business credits, there's a lot of credits that are for clean energy, which I know you support. There's the low-income housing tax credit. Some of the ones I think more about are like-kind exchanges, Section 1202, which is being dramatically abused by very, very rich people, opportunity zones, which often end up benefiting heavily gentrifying neighborhoods that aren't necessarily the most disadvantaged neighborhoods. So I think there are big and small ones, certainly, that should be addressed. But
Yeah, I think I would add to that. Look, I always love hearing about simplification. I'm a supporter of simplification. Unfortunately, it clashes with my realism, which often interferes with simplification. I can say I sort of began my career at the IRS working on the Affordable Care Act. And as many of you know, the Affordable Care Act is actually run through the tax code. And a large reason for that is because the IRS is extraordinarily efficient at giving money to people ideally who should be the ones getting it, or at least more so than any other agency. And so I completely take the points and understand at a high level, the objections. But I think in practice, the IRS is actually kind of the first line for if you want to conduct social policy that way. I mean, the family leave credit is an example of that.
Great. I think we have microphones in the back, so bring one here, and then we'll hold your hands up and we'll look for more. Yep. Go ahead.
Hi, Bob Wyman. Question. You spoke about sort of the incoherency of having an income tax and a cash flow tax at the same time and trying to mix the two. But I wonder, in what you're proposing, isn't there also a bit of a mismatch? Because full expensing is, Kerry Brown told us 1948, full expensing is great because it essentially relieves the tax on the normal return, which in this case would be the cost of capital, and puts the tax onto the supernormal return. But that's setting up a binary. It's like we're not taxing normal return, we are taxing supernormal return. And then the idea is that we can tax rents, supernormal returns without distortion. But the problem is if you come in then with essentially a flat tax on the supernormal return, 26, 27%, whatever it may be, even if there's a couple in there, it's still effectively flat. It's essentially a tax on the quantity of the return, whereas the distinction between the normal return and the supernormal return has nothing to do with the quantity. It's a distinction on the rate of the return. So isn't it odd to essentially set up this binary and then have a flat tax on the quantity of return? Wouldn't it be conceptually more consistent to have a progressive tax on the supernormal return, which is related to the rate of return as opposed to simply the quantity?
Thank you.
I mean, I guess I would say two things. I think there's nothing in principle wrong with a progressive tax on a supernormal return, as long as you'll allow me to have a very high rate at the top. I think there's like a political question of like how progressive could you make a marginal tax schedule on supernormal returns that makes up for sort of the administrative complexity and behavior that comes from progressive versus flat rates, which I think we tend to think of as largely behaviorally minimizing across the rates themselves. So I would just say, I agree with you. You could have a progressive tax on supernormal returns, just like we used to have a progressive corporate tax, and that there's just trade-offs across flat and progressive that one is trading at the policy level when you make those choices.
Other audience questions? Right here. Just wait, it's coming right to you. There you go.
Oh, I do. Hello, name is Dave Onspuck. No affiliation, retired. Maybe I'm a little bit ignorant out there, but I'm just wondering why we can't have a sales tax instead of a corporate income tax. Isn't the income tax, the cost of that income taxes can be passed by the corporations on the consumers anyway. So I'm just trying to think why a sales tax can't be a simpler form than this complicated income tax, talking about the depreciation of this and that, and just during years down the road, and I'm talking about, and income expenses and all that. Why do we even need to have an income tax in the first place if a sales tax can't raise the revenue more simply? Thank you very much.
Yeah, that's a good question, because I think people don't always think about the difference between the incidents, like who actually ultimately pays sales versus income tax. I don't know if Kim or Elena, if you want
I'll start, and I'm sure you have things to add. A lot of countries do rely very heavily on a VAT, which is a sales tax. And, by last count, over 160 countries use these. And if you look at a map, it's like us in Greenland don't. So now I understand. We could rely on a VAT too. I think many economists would certainly prefer that to tariffs. But I think it would be better as an incremental source of revenue than to replace the income tax, in part because of the progressivity issue. Mm-hmm. What any sales tax does is it exempts savings. And, now at my stage in life, I save a lot. But back when I was a graduate student, I didn't save anything, right? And so, the income tax seems to treat me fairly in both regimes, because when I'm a really poor student, I don't have to pay that much. And then when I'm a well-off professor, I pay more, right? Whereas with the consumption tax, it's just nibbling at you all of the time. And so unless we were going to provide the kind of social safety net that Europe and Canada, Japan even provide, then I don't see how we can put all the tax burden on the larger society. So that's why, for myself, I like the income tax too. And just to be clear, the border adjusted cash flow tax is an income tax, yes, in a way. It's taxing rents based on the location of consumption, but it's not the same as a consumption tax. So no one in the room should, not to defend your paper for you, but no one in the room should think of that as a VAT. It's the VAT plus wage subsidy is very different from VAT without wage subsidy.
That's right. I agree with everything. I would just reiterate that in most systems, there's an income tax, a corporate tax, and a VAT. And that's some of why the U.S. has a much lower share of revenue as a share of GDP compared to other OECD countries. I don't propose a VAT because when you say that, people get up and leave the room, because it might be room, maybe. It might be politically unpopular to say repeal the interest deduction, but I actually think it's even more politically unpopular to say we will impose a VAT. So I think all of us have been trying to figure out how to wiggle into a VAT without using the words, because the words are at a minimum quite toxic.
The VATs are still way better than tariffs, just to be clear.
And I think the other point too is that income tax doesn't necessarily get passed all to consumers, right? So when they cut income taxes in 2017, you didn't see big price reductions. Income taxes are spread across shareholders and workers and consumers. So it's not you shouldn't necessarily assume that that's the case. We have time for maybe one more quick question if anyone has one. Quick, 34 seconds quick.
So I remember when I was looking back at the destination-based cash flow tax, there were a bunch of proposed issues. Some corporations might have negative tax liability for a very long time. There's issues where the exchange rate doesn't adjust. It's passed on to consumers. And so I'm wondering what changed? Why is this back in the debate? Yeah.
I would say quick response. In principle, nothing changed. But what I'll tell you is the way that we propose it in this paper is to at least try to avoid what you're referring to, which is the perpetual loss position of Boeing. There's two ways to do a DBCFT. The 2016 version just takes imports and exports out of the base. And that's what pushes some firms into suddenly a very taxable position or a big loss position. If you use an export subsidy and a tariff, because most importers are also exporters, these things can start to bounce off each other in a way that I think lessens the likelihood that large firms get pushed into these perpetual loss positions. But it's one of these transition rules that was a big deal in 2016 and should stay on the sort of transition radar of any policy like this.
And to repeat myself, the appendix addresses that. That's one of the things that they try and go through. So thank you to the panel, to Lily and Kim and Elena and Arvind from Sick Bay. Our second panel can now come on up.
Are we mic'd? Can you hear me? Melanie? Okay. You'll tell me when. Great. All right. Well, good afternoon, everyone. A big thank you to the prior panel and especially to Rich for teeing up this panel so nicely with his mention of the pass-through sector. In this panel, we're going to go deeper into the issues around pass-through taxation. And in particular, we'll talk about a new paper that the Hamilton Project and the Tax Law Center released this morning that examines a proposal to tax large pass-throughs as C corporations. We're lucky to have a fantastic group with us for today's discussion. I'll introduce everyone briefly without doing justice to their accomplishments. Chye-Ching Huang is the executive director of the Tax Law Center at NYU Law and is one of the authors of the paper we'll be discussing, along with her colleagues Miles Johnson, Thalia Spinred, and Kathleen Bryant. Gregg Polsky is a professor of practice at NYU Law and teaches and writes in the areas of federal income taxation, corporate tax, partnership tax, private equity, and executive compensation. Monisha Santamaria is a principal in KPMG's Washington National Tax Practice, as well as a former legislation counsel at the Joint Committee on Taxation, with both practitioner and government experience in all the issues we'll be talking about. And Eric Zwick is a professor of economics and finance at the University of Chicago Booth School of Business, the author of several research papers, as well as a forthcoming book, The Everywhere Millionaire, that addressed the economics and tax treatment of pass-throughs. I want to move us pretty quickly to discussing the policy idea in the paper, but before we get there, I do want to spend a few minutes on some of the problems that motivate that proposal. So briefly, under current law, businesses have a lot of flexibility about whether they want to organize as C corporations or as some form of pass-through, which means they have a lot of choice about their tax treatment. And what we've seen over the past decades is massive growth in the number of businesses organizing as partnerships or S corporations, and also in the share of income flowing to those businesses relative to C corporations. And with that have come a bunch of negative consequences, including lost revenue, tax disparities, economic distortions, wasteful tax planning, and some big challenges for tax administration in the IRS. So, Greg, could you give us the Cliff Notes version of how we got here?
Sure. Happy to be here. Thank you for the invitation. If you go back in the before the 80s, businesses were generally.
Uh-oh. Thank you.
Businesses were often operated as C corporations prior to the 80s, but one reason was because the C corporation tax rates were much lower than the top marginal income tax rates for individuals. In addition, you didn't really have an entity other than a corporation to provide limited liability for all of the owners. And so you saw a lot of businesses in the corporate form in the 80s, and then things started to change. First, the individual rates came way down, making flow-throughs more attractive. In addition, the partnerships that existed at that time, before the 80s, tended to be high-rate U.S. individuals were the partners, and so it's not working. And then it's so there was not as basically the partners were very homogenous. So the income shifting games that could go on between partners was not as significant because you were shifting income from one high-rate partner to another, and the FISC could sort of say, we don't care who pays tax on it because it's at the same rate. In addition to dropping the rates in the 80s, then Congress realized that, hey, we could lose a bunch of corporate tax revenue due to publicly traded partnerships. And so Congress enacted in 1987 the publicly traded partnership rule, which says generally that publicly traded partnerships are taxed as C corps. And one way to sort of think about this proposal is basically just moving that line from public trading. Back in the day in 87, it made a lot of sense because you didn't have your big businesses were public, and if you were not public, you were not very big. But what's changed since then, in the 90s and today, is first the LLC checked the box. The advent of the LLC, you had a state law entity that provided complete limited liability. You had the check the box regime in the late 90s that allowed LLCs to elect their classification. In terms of the business environment, the growth of private equity and dry powder of private equity meant that businesses could get very, very, very large without seeking public trading. And so that line that existed in 1987, which maybe made a lot of sense and wasn't very blurry, has now become not only more blurry, but also less meaningful. In addition, globalization and, now we have heterogeneous partners. We have partners, you can have foreign partners, tax-exempt partners, partners that have capital loss carryovers, NOLs. All of this heterogeneity can be a playing field for all sorts of tax games that partnerships play. So we see that. And then I'll just make one more other observation here is in 2015, we had a radical change. Now, whether it's working or not is a big question in how partnerships are audited by the IRS. And basically the Congress went to a entity type of audit instead of collecting taxes from each partner. The collection is now made at the entity level. Again, one other way to view this proposal is that that's procedurally treating partnerships, large partnerships, as entities. Here, this proposal is substantively treating them. And I'll just add one last thing. It's just the IRS enforcement budget and is not kept up. The IRS enforcement budget with respect to flow-throughs is not kept up with this massive growth as a result of these very diverse sort of changes to the partnership landscape.
And then looking at this from another angle, Eric, can you similarly give us sort of the, in a nutshell, view of what this has meant to revenues and the tax base?
Yes, so thanks so much for having me, and also for the unprompted book plug, which I always appreciate. I'm really happy to be here and talk about this really interesting proposal. So some numbers on tax collections, right? So pass-throughs used to be in the pre-86 world, like pretty small as a share of total business income. They're now more than half of total business income is coming in flow-through form, either via an S corporation or a partnership. Corporate tax collections are, as was stated earlier, less than 2% of GDP. Total revenues are around 17-18% of GDP, so that means that corporate tax collections are roughly 10% of total federal tax collections. It's about half where it was, I think, in that 1980s sort of quote-unquote golden era. But it means that, as activity is migrated out of the corporate sector into the pass-through sector, we're raising revenue in that pass-through sector through that form because the rates are lower there, as Gregg nicely described. I mean, if you're an individual pass-through, you're not paying the 40.8 sort of top individual personal income tax plus payroll tax. You're paying maybe 37, or you're paying 29.6 if you're not a specified service business, now under the 199A rule. So you're paying a much lower rate. If you're a corporation, you could pay 21 if you left the money in the firm. If you paid it all dividend out and paid NIT on that, then it would be back up to around 40. So pass-throughs are still a tax-preferred form for a lot of business owners at the top who are very rich. But then there's all these non-individual owners that we'll talk a lot about that are paying much lower rates on financial income or because they're tax exempts. And a lot of the reason why revenues have fallen so much in corporate, it's not just the migration of activity, but it's also into these preferential buckets with these preferential owners. They're paying very different tax. And so now if we treat them as corporations, then we'll be basically shifting them all back into the corporate form. That's sort of the proposal. As I understand it from sort of a tax collection revenue perspective, how much you raise really does depend on what the rate is in the corporate sector, which we'll talk more about. So I'm going to stop there to keep us on track.
Great. And so before we get there, Chye-Ching, you and I started talking about this paper, I think about a year ago. And I was really excited about this idea because this is a policy idea that does just pop up all the time. You lay out the whole history in the paper, but it's particularly interesting. It's an idea that has popped up from people coming from different ideological perspectives, different parts of the political spectrum. And I think that's because it has a lot of very simple, intuitive appeal, right? As Gregg talked about, a lot of the problems here come from giving big businesses so much choice about how they want to be taxed. So it's natural to ask, could we solve the problem by giving them less choice or no choice? But as you talk about, most of the prior iterations looking at this have stayed at 10,000 feet, whereas you and your colleagues
work through a really concrete proposal, get all the way down into the wonderful and very weedsy appendix, which I highly recommend. But can you talk at maybe a 5,000-foot level about the specific proposal you developed and what you learned from working through those details?
Yeah. I mean, it has just kept coming up and up and up. And this is not where we sort of started when we were looking at sort of fixing pass-through and partnership taxation. We actually did a previous paper with the Hamilton Project looking at direct fixes to the pass-through tax base, both big and small. And as we were socializing that, people just, I need to use the mic. Okay, very good. As we were socializing that list of direct fixes to the partnership tax base, people kept asking us about this idea that had intuitive appeal. And we went and looked for a recent detailed version of the proposal so that we could get a sense of what it was like, and we didn't find one. So really what this paper was about was, taking that idea that was either conceptual or old and trying to turn it into something tangible that we could then poke at and see whether or not we liked it. And we came in pretty open-minded about whether the devil in the detail in that 30-page appendix would be fatal to the idea, or whether it was one of these good ideas that just required someone to do the hard work of getting up close with those really tricky design choices that have trade-offs and are never really completely satisfying in the way that you resolve them, but that sometimes might be worth resolving. And the basic approach that we took was based on some of those prior proposals. We would treat S corporations and partnerships with gross receipts above $25 million as C corporations. That was the base proposal that we looked at. And the Tax Policy Center estimated for us that at the current rate structure, it would raise about $140 billion over 10 years, but that would rise to some $500 billion over 10 years if we were in a world where the rate was around 30%, which, as we were discussing in the prior panel, that is part of the set of potential futures that lawmakers might be considering. It would only affect the largest 0.7% of pass-throughs, but about half of all pass-through income. 94% of the burden would fall on the top 10% of individuals who own those businesses, and almost 66% would fall on the top 1%. And through all the hard work that my colleagues in TPC did getting into that sort of detail, we learned a lot about what design choices are the most challenging and high stakes for lawmakers to grapple with in order for this to be something that could be a real thing.
And so where does that leave you? Is this something people should do?
Yeah, I mean, very loyally /economisty, it depends. So we do think ultimately the policy can be made workable, and it really does belong in the menu of what we think of as options to raise revenue and do so in a progressive manner for all of the reasons that have been discussed in the prior panel. But it depends on, number one, getting some of those design details right. And it also depends on what choices about business and individual taxation lawmakers make, and what other options they kill or keep alive. So happy to sort of get into some of those details, or what states of the future it makes most sense in, if that would be helpful.
Yeah, why don't you say a word about that, and then I'm going to ask the same question to the rest of our panel.
Yeah, so look, important design details, and I'll be grateful to hear from Monisha and others about whether or not these can be resolved satisfactorily. We come down on thinking yes, and I think others can take a reasonable other view. But how do you define large? What is the choice of your threshold? Is it receipts? Is it assets? Is it a combination, something else? And how do you make sure that entities can't split themselves up to get below the threshold, something that attaches to other proposals that are already in the tax law or to things like graduated corporate rates? How do you deal with those sensible transition rules that came up in a big way in the prior panel as well? And yeah, we really do agree with Arvind hovering on the panel over there before, that these details really do matter, and they need to be sort of got to grips with before sort of jumping into something like this. And our goal was to try to sort of get through as much of that thinking before something like this became live, in part because it has so many people, smart people, who have said, why don't you think about this before? It's most attractive when corporate rates are higher than individual rates. That's really clear. We have no idea what sort of preferences lawmakers will have on that in the future. And it also depends a lot on what other options are locked into or crossed off any other package. I remember when we were doing real business taxation revenue raising last, and Senators Manchin and Sinema had some pretty idiosyncratic preferences. And we don't know who's going to be in the driving seat next time, and we don't know what their preferences are going to look like or whether they will make sense to all of us policy people. So I think it's upon us to make sure that the second and third and 10th and 15th best options are as good as they can possibly be, so that when all the negotiation is done, you're left with something that does actually deliver revenue in a way that is administrable.
A compelling case for all of the work being done on all of these ideas. Let's just go to each of the panelists. Same question. Is this something policymakers should be pursuing over the coming years? Starting with Gregg, and we'll just go down the line.
Okay, yeah, there it goes. I can be very quick here. I like the idea. I'm a big supporter of the idea. The devil is obviously in the details. I mean, Elena talked about taxing sole proprietorships as businesses. And so this idea that we tax businesses differently. I mean, in an ideal world, we should tax all business income the same, regardless of how big or how small or how many owners there are. But practically, politically, the idea of imposing an entity level tax on a sole proprietorship is probably too much of a lift. And then other types of partnerships that aren't as difficult to administer. I like the idea of changing the big versus small distinction in 87 with 7704. The public traded partnership rule was public trading, and just that's no longer a really good distinction. And so I think another distinction makes sense. It's hard to do that, but it's also, my conclusion is that partnership tax as it currently exists is completely irretrievably broken. There's just you can try to do stuff. I guess if you were to radically increase the enforcement budget and radically think carefully about fixing some of these rules in an alternate universe where we can do that, maybe it could be fixed, but I'm not betting on it. And so I like this as the best alternative, the best realistic alternative.
Monisha.
Thank you for having me. I'm really happy to be here, and I really thank the authors of this paper for thoughtfully addressing many of these really, really hard policy choices. I do recommend that everybody spend a lot of time with the appendix. I think that's a point that we all will make over and over again. I fundamentally agree with the premise that partnership taxation deserves attention, since the world that the Sub-K rules were enacted in is very different than the world today. Subchapter K was enacted in 1954 and has seen relatively little change since then, and the world just looks differently. You have cross-border partnerships, you have related party partnerships, you have internal partnerships with corporate partners, and the system wasn't designed to care about which partner paid tax, and we've made that point before. And because the system wasn't designed to care about which partner paid tax, the system embraced both optionality and flexibility. I think that optionality is something that people can legitimately find fault with, and optionality, when I say it, is the ability to make choices just based on tax items. Flexibility, which is where parties join together to have diverse economic situations with non-pro rata sharing, is something I think we should want. It's existed since the Roman times. You can find stories in the Chronicles of Cicero. So we have to think about what we're upset about, optionality or flexibility. I think that's really important when you think about reforming pass-through taxation. But I also think that the idea of taxing large partnerships and large S-corps as C corporations goes too far. And it's the wrong response. It sounds simple, it pulls well, but it's simple in the way that going through a wall is simple. It sounds good, but it just doesn't work. It skips too many steps. And I have unfortunately or fortunately spent way too much time thinking about it. I think what Subchapter K does well in the base case is that it tries to align tax and economics. A system where you reduce all flexible economic arrangements to shares of stocks will divorce tax and economics in some situations. The paper acknowledges that in the appendix, that trying to put concrete rules in place rather than principle-based rules is basically too hard. So I think the potential to divorce tax and economics is very dangerous to the fisc, and will create a different set of issues similar to the issues today that bother people in this room and policymakers. And one point there is having a saying, because, non-for-profit economics is hard, we should forbid them. I don't think that works. I don't think it's what we want. It is like we will just stop productive business activity. So I think we have to embrace a system that embraces flexibility, and I think you need a system of pass-through taxation to do so. My second main gripe with the proposal is that it provides an ability to tax income at a lower rate, assuming today's rates, or any system in which top individual rates are higher than the corporate rate. So basically, if you have a pass-through system turned corporate system in which entity level income is taxed at 21%, and there's no mandate to distribute it, income that today is taxed at the top marginal rate, 37%, or 29 point something percent if you have 199 at play, is now taxed at a lower rate. And entities will not be forced to distribute profits. People can engage in a variation of buy, borrow, and die, and I think that would be really common, and that behavioral response is something that I think people really need to think about before it going forward with this idea. So I think that is one of my fundamental concerns with this paper if you just care about revenue. The revenue raised from this paper, and we'll get into it in a second, is not that big. It's $140 billion. If you think about the amount of guidance needed for $140 billion, and the number of Treasury Reg pages you need for $140 billion, this might actually, rank there with KMT as not a good ratio or bet. Also, this proposal touches S-corps and partnerships, and trying to get anything that touches S-corps through Congress is really, really, really hard, as I think other people in this room will agree with. So I think that, by the time you do that, and drill it back for S-corps, which I do think is likely, that number is going to be even smaller. And finally, I think that many of the industries touched by this the industries that this proponents will want to touch, private equity, real estate, hedge funds, law firms, accounting firms, internal partnerships, won't be impacted. We can get into exactly why later, but I think and the appendix does a really good job of acknowledging this. That's another fundamental concern I have. So now that I, put forth a lot of concerns, I do want to go back to my main point in that the authors did a really good job laying out some of the hard design choices, and reading the appendix is a necessary step for any policymaker trying to put this into legislative text. I'm going to turn it over to Eric now that I complained a lot.
I think that this thing works for some reason. I was blessed with a lavalier microphone. Right. So I guess it's useful to just remind ourselves why are pass-through paying lower tax rates than traditional corporations, absent the 21% and leaving the money in the firm. One reason is the rates are lower. That's sort of a political decision, right? And so there's subchapter S, the S corporations are pretty simple operating businesses largely. And it's really just more a question of what rates politicians want to pay. Want businesses to pay. What rates the S corporations pay. Second is there are buckets of income, right? Ordinary income, dividends, interest, rents, etc. Preferred capital income that has lower rates. Again, policymakers have chosen those preferred rates in those buckets of income. A lot of income in the partnership sector, the subchapter K sector now, is in this preferred rate bucket set of things. And it's not clear a policy proposal that focuses on gross receipts, so that's revenues, normal income, would even touch all the financial partnerships or real estate partnerships where a lot of the income is in these preferred buckets. And that's, I think, where a lot of the complexity in the partnership sector is. So I think, there's a little bit of richness, nuance in the underlying of pass-throughs that's relevant. The third reason pass-throughs have low tax is complexity. Again, mostly in the partnership, lots of tiers, pyramids, circular flows, loops and hoops and stuff. Such that the income can be really hard to find, and it becomes sort of really hard to audit also just operationally, which means the tax system itself is kind of an honor system for these entities. And, I think the proposal actually is on its strongest footing when it's like emphasizing we're going to harmonize rates across types of firms and then let politicians choose the rates that we think are like politically feasible. But like harmonizing rates is a good priority. I like that idea. And then we're going to try and simplify the structures if we can in different ways. And I think what I would like the proposal to do is to try and pull in more of the entities that I think are generating the complexity that makes it hard to audit and collect tax revenue. I'm concerned there's like this view that, oh, C Corps have much less of an audit compliance issue, and we audit them much higher rates. If we just treat pass-throughs like them, then magically we'll collect the revenue that they owe. But we actually need to audit them the same way we audit C Corps, with the same level of resourcing, the same attentiveness, the same like humans thrown at the problem, I think. And I'm not so sure that's like as brought out as much. I'm also not sure like we need to tax them like C Corps in order to get them to flatten the pyramids or unwind the circles and loops and stuff, versus just an inter-partnership little dividend tax like what we have in the corporate sector, the intercorporate dividend tax, which was legislated in the 1930s to flatten all the pyramids in the trusts that like drove like the great crash and stuff. There's like amazing Randall Moore tax policy and economy paper all about the history of the intercorporate dividend tax, which I think some of the simplification motives here can be achieved by. But like, so I really like these aspects, the harmonization and the focus on reducing complexity in partnership sector as a way of trying to collect tax. To me, I agree with Monisha, this is not a way to raise a ton of revenue unless we also raise rates across the board on lots of business entities and the personal rates potentially as well for these business owners, which the proposal maybe is just like trying to set the stage for us to then do that. We're not going to raise a lot of revenue unless we do that.
So there's a ton to dig into here. Maybe starting where Eric left off with this question of audits. I think there's a question of, do you make it easier to audit these entities by taxing them at the entity level, or do you fundamentally face the same problems? And Greg, maybe to start with you on that question.
Yeah, sure. So yeah, partnership tax, like the way it's designed is super elegant. Like I love teaching it actually, because it's a problem. You're trying to allocate tax items up to the owners. You're trying to allow people to contribute property without recognizing gain or loss, and the partnership can distribute property without recognizing gain or loss. It's really an elegant, nice system. It's just completely unworkable. It's just completely unworkable. I mean, beyond the simple partnership. And again, Monisha said when Subchapter K was designed, it was me and Chye-Ching get together, and I'm a sole proprietor and she's a sole proprietor. We get together, and we don't want to discourage us from getting together, so you don't want to tax us more harshly. But at the same, we're trying to tax you in that manner, and so it's just so much easier when you don't have to allocate tax items. And you collect the tax at the entity level. Again, the 2015 audit changes. They seem to be very undercooked. But the spirit is like, we just can't do this anymore. We cannot attempt to collect all this revenue from all these disparate partners with all these tiered partnerships. It's just, we'd love to do it. In a perfect world, we would do it. But we have restraints all over the place. And so we can. And so we're left with, sort of a second best alternative. Again, I love the idea of partnership. It's just, it's, and I didn't have this, I've been teaching that for 30 years. When I started teaching it, I would have had a completely different reaction. But I've just come to the cynical, sort of practical view that it's irretrievably broken.
Well, I think you're sort of picking up on something in terms of like the complexity there that gets to, I think, what is Monisha's sort of main objection, which is Subchapter C corporations, one flat rate at the entity level, and then like different things happening at the shareholder level that don't necessarily all match up. It's a rough justice system. It is absolutely a rough justice system. And if you are in a situation where economic reality, which is true for a lot of businesses today, is actually complex, and you want to match that economic reality, there is a really sound rationale to have a system that allows all of these intricate adjustments to reflect that really intricate economic reality. So I think that is like the core justification for the pass-through tax system that currently exists. The problem is that it is not doing very well at the moment with respect to the rules of matching economic reality to the tax treatment. There's way too much flexibility, way too much optionality, so that the economics and the tax treatment are out of whack in ways that are depriving the fisc of revenue. And in addition to that, all of that complexity leads to tax administration systems, which is why Eric mentioned, like, it's really an honor system at the moment. Now, I think maybe one of the core underlying differences between me and Monisha is that I'm not taking a strong bet on us being able to fix the underlying pass-through tax rules. We did write, to be clear, a whole paper for Hamilton a year and a bit ago about how you would go about doing some of that. But again, in a world where we don't know who's going to be crossing lines through different things, and we want lots of options, and coming back to, like, what is your core, like, priority here? I come back to where we sort of started this. The fiscal situation is more challenging than it's ever been. Revenues are lower than they've ever been in the last few decades as a share of GDP. And we have really big national challenges that we are going to need investments to face. And so raising that revenue in a way that is acceptable and progressive is, I want to have a good stack of options for that. So I think it's a very important, like, choice that lawmakers will be facing when they look at a proposal like this, which is like how rough justice is okay, how much rough justice is okay in our business tax system. I think it is a really core and important question, but I think the thing that we all agree on is that, like, where we are currently is not sort of meeting the mark, and whether you head in a direction where economics and tax is more aligned, or a rough justice system where the misalignment doesn't matter as much for the fisc, I think that's a choice to be made.
And Monisha, picking up on that, I wanted to come back to what I thought was a really fundamental point you raised, which is, can you preserve flexibility while eliminating optionality, right? That's sort of this question of, is pass-through taxation fixable? So I wanted to come back to you with that question directly. And also, since I know you agree that the status quo is not in a good place, what alternatives you think are more constructive to pursue?
So I think you can do a lot within the current system to preserve economic flexibility and align tax and economics and get rid of optionality, which was put in the code 50 or 70 years ago because the FIS didn't care. There are a number of ideas that have been floated by different parties, different members of Congress, and they are drafted. And it is easier to criticize a drafted idea because there's specifics and you have to make those really hard design choices. But if you go look at Wyden put out a pass-through reform draft, there are a lot of changes in there. Kim put out many changes, and some of them overlap. And some of the specific drafted ideas get rid of optionality but not flexibility. These include ideas like changing which methods under Section 704C, which deals with built-in gain property, you can use. There are three choices. You could argue that there's no need for there to be these three choices because those just give you tax options. They don't allow you to have more economic flexibility. That is a very controversial idea in some choices, but you can see why somebody would think that makes a lot of sense. There are a number of changes in the related party context where the optionality and flexibility don't really do much in terms of advancing any economic aims that you could make, and those are, and there, a lot of those are in Wyden's discussion draft, and all of those keep subchapter K intact because even when we design a new system within sub C, if we do go forth, you're going to have to make some of the same policy choices that were made when the drafters of the original sub K in 1954 made it, and you're going to have the same issues. So it's like just moving the problem, which I think is one of my fundamental concerns with this proposal. It isn't fixing what's fundamentally wrong and perhaps unfixable with any business taxation system. It's just moving it and would likely result in a game of whack-a-mole by the FISC. I think one of the issues with subchapter K today is that the game of whack-a-mole hasn't been, like, somebody stopped doing it a while ago. You see... You saw some changes in like the 70s and 80s that were trying to address specific problems, but subchapter K hasn't really been touched like fundamentally in 50 years. So the game of whack-a-mole hasn't caught up, and the game of whack-a-mole and the need for it is caused by both economic changes and changes outside of sub K in the tax code. And those problems don't go away by just moving it over to existing sub C. You just change the location, and it takes the government even longer to catch up. And I also think it's really, really important to note that if Congress enacted like a proposal like this one, it would take enormous Treasury resources to implement it, and that cost in terms of things that aren't getting done in other areas and time from revenue raises that are easier to implement, like changing existing sub K, is something policymakers should take into account.
Kind of want to try to save a future Treasury some time and effort is part of the reason why I think it is actually important to have draft legislative language, to have appendices that run through all of these issues, and to have good faith poking at the problems from experts like yourself well before legislators get to the point of putting lines through things. Because as we sort of talked about before, Campty, old language from 86 with a bunch of exceptions written in, right? If we all knew that was going to be the thing, that was really going to be the thing, and you locked a bunch of us in a room and said, you got to make this thing as best as it can be, maybe it could have been better, right? So I think that's part of the motivation for the paper. I do want to keep returning to the point that you made. One of the reasons that we got these fantastic estimates from TPC at different rates was to not only make really clear that in terms of the juice being worth the squeeze, it is way more worth the squeeze at a higher corporate rate, but also to make the sort of point that this event is somewhat making, right? Which is, don't just think about the C Corp tax, right? If you don't do something on the pass-through side, when you raise capital taxes through C corporations, if you don't do that, you will have a lot of revenue income attributes flow to the pass-through sector, and you need to do something there to backstop it. So one of the interesting pieces that you can look at in the paper is that it shows you the interaction between corporate side rate increases and these pass-through changes as well. So again, there should be a menu of things that could happen on the pass-through tax side, but if you're not dealing with pass-throughs and you're not dealing with international, then your sort of core changes to the domestic corporate tax base are not going to work. And I think that's a really important part of just lawmakers thinking through this big question that is business and capital tax reform.
Monisha, I can tell you want to get in, and then I also want to come back to some points that Eric raised.
Well, let's go to Eric first, and then...
Well, so I specifically wanted to ask, you talked about sort of the most attractive part of the proposal being the part that sort of takes on complex partnerships. There is a discussion in the paper of alternatives where the trigger for C Corp treatment would be not size, but complexity. And so I wanted to ask, do you find those more attractive? And then also put that question to others on the panel.
So I think trying to figure out what set of aggregation rules should apply to any proposal, including this one, is a really, really hard question. And I think you've seen attempts by Congress to change aggregation rules to take away, really, to take away some issues that some might say are obvious. And that attempt did not go well for advocates of that change. So you have to think about what is doable in the aggregation context and what is administrable. So trying to create a system in which you have 3 different tests to figure out if you're aggregated, and it is specific to each regime, that is not administratable, and that seems like a really hard political left. So I think we all agree that the aggregation rules that need to attach to this proposal or Kim's proposal all are really, really important. We also have to figure out what is doable and what is administratable, because having highly complex aggregation rules that deal with all the policy issues across all kinds of different industries might sound great and might be really fun for this room to discuss, but then we have a problem of getting them over the finish line and then having anybody apply them and audit them. I will say, for example, KPMG has the Section 52 aggregation rules and new foreign parented multinational group aggregation rules. And the fact that there are these 2 different regimes and nobody knows how the new ones work and nobody actually applied the old ones correctly is creating problems for both the IRS and taxpayers. So we have to come up with aggregation rules that are simple, universal, and actually work, and that's a really, really heavy task.
Greg, did you want to get in on this, and then
Yeah, no.
we'll
So
talk about
I think my thing works still. I like I like the idea of trying to flatten some of these pyramids through some mechanism to make it just actually functionally possible to audit like these entities that are clearly interrelated. And I'm trying to also bring it back to like, what are the concrete economic actors or entities that we're trying to like solve the problem that we can't tax them very well? And I do think a lot of the issues are in like private equity, financial services, real estate, holding companies where each apartment building is a partnership with different ownership structure, but there's like a lot of common ownership as well. Like there's like a subset of sectors that are quite narrow. Like it's not the auto dealers that, you know, we read a lot about in the book. It's not the the beer distributors, you know, it's not the mid-market manufacturers. Like they're pretty simple, even if they're quite large. And for them, like if you want to harmonize the rates, it's just about 199A or just about like the personal tax rate. But like the financial and real estate partnerships, there, I think different approaches to causing them to look like more like one entity, like so you could audit Blackstone as a single entity with all the partnerships underneath it, or like because it's kind of like GE which is a really large multinational company with lots of subsidiaries that you kind of audit every year. Like these kinds of ways of treating these big investment partnerships, or maybe it's each fund is an entity that you could audit even though they have a bunch of subsidiaries. But like creating an infrastructure to do that, I love that idea. Whether taxing them this way is the right way to do it or some other proposal, I think that's sort of like the goal or vision for simplifying taxation of pass-through that's like separate from the rates we charge on the simple businesses.
And one thing, I think when we think about trying to think through what rules make the most sense, when Congress passes a law, it sticks around for many, many centuries, decades, if not centuries. And having rules that are historical and geared to the times might make sense, but that's why we're in this place, right? While we're having this discussion right now, creating rules that are like reactive to PE structures or any other specific structures that don't take into effect that the world will change, I think is dangerous.
Or like the tax code is like a house that depreciates and you just kind of got to invest like occasionally to like fix the windows or like re-tuck point the bricks and stuff. Like I kind of have that view of the tax code because the economy is evolving all the time.
I will say, I don't think that the aggregation issues are insurmountable. I think, you know, it's an on-off switch, and once you're in forever. So, and I guess, and people might be, you know, traumatized by the whole Campty experience, but I just don't think that that's going to be all that difficult relative to having to enforce all of these intricate subchapter K rules that, I mean, I couldn't teach subchapter K in like less than 15 hours. It would take me 15 hours to explain to really smart people a general idea of how subchapter K works with common transactions, contribute property, the property is sold. But, you know, this is an aggregation test. I mean, we can figure that out. I just don't think that that's all that difficult. And I will say that you're going to also have to have the enforcers on the ground understand what they're doing. And I just think and I've seen it, you know, personally, it's an insurmountable task to get revenue agents to understand the intricacies. It's an insurmountable task to get some of my NYU law students who are brilliant to understand the intricacies of subchapter K. It's just not going to happen. But in terms of some suggestions along the lines of modifying the proposal, you talk about. I think S corps can come out. I mean, S corps are really simple. I don't think there's problem. I mean, there's the loophole. There's the Medicare loophole, which is completely separate. But S corps are really simple. I also would think that maybe you'd want to exempt partnerships that only have U.S. individual partners, because the game playing that can go on is much less significant. And again, maybe politically that's easier to keep the status quo for sort of the mom and pop situation.
Can you repeat into the mic my question? Why should those entities be paying less than like an exactly similar operating business that's a C.
So the question is, why should those entities, let's say again, let's take a partnership that has only high rate U.S. individuals as partners, why should they be taxed differently than a business that
so they'd
has
be paying 37
same business,
versus
same business, different, and then there's one corporate owner. So that would get out of my safe harbor. The S's. I would say again, it's all practical. You have S corps that exist now. They're mom and pop.
They're not all mom and pop.
They're not all mom and pop, but they only have one. They only have U.S. owners. They have one class of stock. That's not. I can teach S corps. I said 15 hours it would take me to do a basic partnership. I could teach S corps basically in 35 minutes. It's subchapter S is plain vanilla. You can't contribute distributions of property or tax. It's completely. You don't see games in the S corp world other than the employment tax game. But
Not getting a sorry.
no, I'm just saying it's pragmatic. Again, I would like to. What Elena was saying earlier, I'd like to tax every business the same. Okay, let's just tax every business the same. I don't care for the sole proprietorship, but I'm too much of a realist to realize. So I think you'd have to leave some space for, businesses that don't have the risk to sort of continue to operate the way they do.
But Gregg, once you add all the exceptions and deal with all of the issues in the appendix, are you sure it's going to take less than 15 hours to teach?
It'll be easy because again, basically you take the S corp rules and you say if you could qualify as an S corp and you want to stay in partnership form, we won't count your revenue, and you can just again the law firm partnerships. They're all high rate U.S. individual partners. There's no, again, leaving aside the Medicare loophole, there's no income tax abuse at law firms that are partnerships. And it's not that difficult to enforce because, again, they're all U.S. individuals. I think it's the tiering that makes it, and particularly, and again, the heterogeneity of the owners that really creates the game to shift income and play games.
So I'll step in and plug the appendix again, because I think it does have a very nice discussion of these different ways of thinking about the goal of the proposal. Is it to tax all large firms the same? Or is it to go after complexity? And then there's like a choose your own adventure of code sections that Gregg would have to teach us tomorrow in terms of how you modify the proposal around that. In the meantime, why don't we take a couple of audience questions? I know we have mics in the back. Do not be discouraged by the code section references. There must be questions. Yes, here. And then also encourage additional questions from people who haven't jumped in before.
Sort of going back to the session before, if we've got full expensing, so essentially there's no tax on the normal return. It's essentially government's return on its investment. The tax is only on the supernormal return. So why don't we tax all businesses the same, whether they're partnerships or corporations or whatever? Because, in theory, the tax on the supernormal return should be non-distortionary or at least less distortionary. And frankly, we don't want people having massive supernormal and supernormal returns. So why don't we just tax them all the same as long as we have full expensing?
And I'll just add to that question and say to the panel, if we did move in the direction of a higher rate cash flow based tax, does it have other implications for how we want to tax pass-throughs? Eric, you want to start?
Yeah, just to clarify, just because it's called capital, in the tax codes and national accounts, doesn't mean it's actually returned to capital. So because the rates have been lower in the pass-through sector for so long, a lot of income, the underlying economic nature of which is human capital or labor, you could broadly define what that notion is classified as capital income or pass-through profit. There's no investment happening there at all. And you might call that supernormal, you might call that a normal return to human capital. It's more about how much is it distorted by the tax rate, and also what's the tax rate alternative from the personal income tax on that same type of income where it earned as a lawyer working with a wage versus a partner earning it as ordinary income subject to a different tax rate. And I think the business owners that run the types of businesses that are operating in the S Corp, in sub S, which I agree with Gregg is simpler to tax, a lot of that is human capital income, and you're taxing it, I think, you want to tax it like labor. So it's a little bit different from your supernormal normal return question that's for multinationals and capital intensive industries. So I just want to flag that.
I think we need to think about where we are in this moment in history, we are not starting with a blank sheet of paper. We have to work within the existing system, and saying we're going to rip it up and start all over from scratch isn't politically feasible or practically feasible, to say the least. So I think what is important is to figure out what is in the realm of possibility, what can be on a menu option, and then work from that starting point. And if you look at history, any attempts to talk about integrating the business tax systems have generally fallen through after lots and lots of years, lots and lots of angst. So it seems to be more practical to think about what is possible and doable. Also, any set of transition rules to try to get every business entity towards a similar or the same system, like those types of questions run into insurmountable problems really quickly. So I don't think it is a practical use of time, to say the least.
I think to the sort of core of your question, but also taking your point about some of this return is probably just disguised labor income. I think Fox and Liskow and Love have a recent paper that suggests that if you end up converging towards a business cash flow tax via expensing, the variable rate structure of pass-through taxation becomes more inefficient and prone to generate potentially negative tax rates. So they suggest that actually going in that direction is one reason to do something like this that unifies at a C corporation treatment or some other kind of type of entity treatment. I guess I'll just sort of plop in here again, sort of coming back to the big picture and revenue and some of the discussion we saw on the prior panel, like do you go towards expense and do you go towards economic depreciation, et cetera, et cetera. These differences between different forms of capital taxation and then the choices that flow from that, including your entity taxation. I would put all of that actually in the scheme of things like a pretty small consideration relative to the revenue, given what we've seen in terms of our current fiscal situation and revenue needs. And also that we've seen recently that in packages that lawmakers actually pass, these second order effects on growth and revenue feedback are much, 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 much smaller than the impact on interest rates of the fiscal change in terms of how much revenue you're raising. So it's really important to think through like what you are trying to do economically and what your goal is. But when it comes down to sort of choosing from this menu, I kind of sit a little bit more agnostically in terms of like rating some of these second order things and much more sort of care about some of that sort of basic revenue distribution and administrability questions.
Anyone want to respond to that? Otherwise, I will ask one last question in a different spirit, which is we've spent much of this panel, Monisha, you make a great point about path dependence. We're not starting with a blank slate. We do bear the burden of all this history. But for the last question, I'm going to grant you a time machine. But it's a time machine that can only be used to modify the history of pass-through taxation. And so I'm going to ask, what would you go back and reverse if you could go back to a pivotal moment in the development of this messed up system that we have? Anyone who wants to go first.
This is going to be cheating to answer that. But I would say that, again, starting with sort of my first comments here is that I think partnership tax sub K was not a mistake. It's just it's outgrown its usefulness, if you will. And again, I think it's a combination of the political inability to fund the IRS adequately, combined with all the other things we've talked about. That it made sense when it was first born in the 50s, and it made sense for a little while, and it just sort of outgrew its usefulness. And the 1987 change to tax publicly traded partnerships as corporations, that made a lot of sense then too. It's just that switch, I think, has become, because of private equity and other things, has become less of a good toggle, if you will. And so we need to change the toggle, and that's the way I view this paper. So I don't know, it's kind of a punch on that question.
Monisha?
I think where history, quote unquote, may have gone wrong is not updating the rules when the FIS started to have a stake in which partner pays tax. And I think every time the tax code was updated to create a system where different partners had different tax attributes based on changes outside of sub K, somebody should have thought about the pass-through impact. And I think that is a lesson we can learn right now as we make changes outside of sub K that impact sub K, assuming this paper's idea doesn't come to pass.
Yeah, I mean, I guess I wrote something somewhere else called "We Should Party Like It's 1997." It was about going back to the glorious budget surpluses of 1997, and so this proposal by itself raises sort of roughly $20 billion a year, something like that, 2025, something like that. That's like 1% of the deficit. That's like a pretty small, share of GDP. But going back to 97 in terms of how we would tax pass-throughs would imply removing 199A, which raises 3 times as much probably per year, maybe 4 times as much by itself. So basically harmonizes that rate back to the individual rate. And also the bracket structure goes back to a more progressive bracket structure, not just at the top, but in the middle, upper middle, to a place. And that's probably 2 or 3% of GDP, kind of those personal tax rate changes. A big chunk of it would come from taxing pass-through business owners more, I think.
Assuming sequential use of the time machine, they've fixed it all. So maybe I'll also fund the IRS to be able to actually administer whatever tax system we have now that they've fixed it all.
I like how my time machine becomes just a magic wand.
We all want a magic wand.
A huge thank you to all of our panelists, all of our authors, all of you for attending, anybody watching online, and for those who are here in person, please join us just outside the room for a reception afterwards. Thanks, everyone, and have a great rest of your day.